Imagine your entire financial future suspended above a canyon, held up by just one thread. If you rely on a single source of income or a single asset class to survive, that is the exact position you're in. That tension is constantly being tested. Sudden mass tech sector layoffs, AI rendering specialized skills obsolete, or rapid inflation eroding purchasing power can snap that thread without warning. The historical record documents market panics erasing ends practically overnight. These crashes are a recurring reality, visible in the faces of those who saw their stability vanish in a single afternoon. Standard financial advice often ignores this vulnerability. People are encouraged to pour their energy into aggressive asset growth, but that focus usually requires concentrating your bets, which makes your entire life fragile to a sudden drop. Chasing the highest possible return on paper is mathematically useless if a single unpredictable event forces you to start over from zero. Hedging provides a mechanical solution to this fragility. It functions the same way as a standard health insurance policy. You choose to pay a small, predictable cost right now to ensure you are protected from a catastrophic hit if you get seriously sick or injured later. In a financial context, this means moving away from the impossible task of predicting the future. Instead, you actively engineer a backup plan to absorb the impact when things inevitably go wrong. You stop betting all your chips on one optimistic outcome. You spread out your exposure, balancing your risk across multiple, overlapping realities. A portfolio made entirely of stocks is fully exposed to the chaos of the trading floor. When market sentiment turns negative, massive blocks of equities can crash simultaneously, taking your net worth down with them. Investors counter this by introducing physical gold into their holdings. During deep economic crises or stock market panics, gold typically rises in value or remains stable, acting as a counterweight to falling stocks. But market crashes are only one type of shock. To survive personal disasters like a medical emergency, a sudden job loss, or a business failure, you need a liquid emergency fund held in cash. Cash on hand solves a specific mechanical problem. It guarantees you will never be forced to sell your long-term investments at the very bottom of a market crash just to cover your immediate bills. Gold and cash act as a financial parachute. They are engineered to stop your free fall when the growth in the stock market inevitably reverses. The next layer of protection addresses another vulnerability, keeping all of your purchasing power tied to the health of a single national economy. You can hedge this by dividing your cash reserves. For an investor in India, holding United States dollars protects against domestic inflation and the weakening of their local currency. If the US dollar weakens globally, those local Indian investments become relatively stronger. Holding both creates an equilibrium where one currency catches the other's fall. This same logic applies to how you earn your money. Relying exclusively on a single corporate paycheck leaves you exposed to a company restructuring or a bad quarterly report. Building an income hedge solves this. By developing secondary revenue streams, like consulting, a YouTube channel, or physical real estate, you build a safety net that catches you if your primary job disappears. Decentralizing both the money you store and the money you earn ensures that your survival never rests in the hands of a single boss or a single central bank. Making this practical requires 3 habits: consistently saving cash, deliberately dividing your assets across different markets, and learning AI-native skills so your career remains relevant. On this chart, the jagged line represents a 100% stock allocation during a crisis, while the smooth path shows a hedged portfolio. Notice the trade-off. Hedging sacrifices a fraction of peak growth to completely bypass devastating bottoms when markets collapse. This approach prioritizes avoiding financial destruction above all else. Success is measured by long-term sustainability rather than the temporary peak of numbers on a screen. Successful investors and entrepreneurs treat survival and growth with equal respect. By doing so, they earn the greatest asset of all, the emotional resilience required to sleep soundly through any crisis.